Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, the 3rd of July, 2025, of course, about 7:30 in the morning. So just recording this before 8:30, where we have a huge amount of data. We obviously have the non-farm payrolls, but we also have the initial jobless claims, and later on we have the ISM sort of services. So a lot of data. But before we get into that, I just want to have a quick look and just look. Interesting overnight, there was a big panic yesterday. This is the 10-year gilt, so the 10-year bonds in the UK. And there was a big sort of panic yesterday, without going into too many details, that essentially the market thought that the UK government was losing control of its fiscal discipline because they sort of talked back or walked back some cuts to social services. And there was this whole idea that the Chancellor of the Exchequer, Madame Reeves, was not being supported by the Prime Minister Starmer. So there was basically a crisis of confidence. So what we see here is the UK gilt yesterday had a big down day, pretty big down day, which was actually reflected also in the bonds and also in the US treasuries. But overnight, what we've seen is that the UK sort of Prime Minister Starmer, he went on sort of TV and all the media outlets and basically said that he loved his Chancellor. She had her full support. She had been crying in Parliament, but she said it was a personal issue and that she's going to keep her job and we're all one big happy family again. Anyway, so all that to say that the UK government did its best to sort of reassure markets. So what we've seen this morning is the gilts, the 10-year UK bonds here are kind of pushing a little bit higher. And of course, that's had a little bit of a overflow. If we then look at the bunds, they're up a little bit. Let's just looking at the French bonds up a little bit. Also, the Italian bonds up a little bit. And if we go across to the US and the 10-year, not so much. It has other concerns, but still it's just coming back a little bit from yesterday. And if we just to finish on that, if we have a look at the pound was absolutely sort of whacked yesterday on that news, because I remember at the moment, and you see here this on the daily chart, the pound sort of came down. But again, like with the rise in the gilts, that's sort of pushing up. And it's interesting that the pound at the moment is not really trading on the yields. So it's not so when the yields go down, the pound goes up, and the opposite. It's actually sort of a different situation where it's trading. It's the correlation is with the yields. So as the yields are going up, it's anti-correlated, and the pound is going down. So that's sort of unusual, because that's almost sort of like a sort of a developed, a sort of an emerging market kind of dynamic with a lack of trust in fiscal discipline. So what we're seeing at the moment is that the pound is going up as those yields are going down. So that's one to be looking at. Okay, other news overnight, just quickly. Interesting, over in Switzerland, we got, let me just bring it up here. Over in Switzerland, we got a lower than expected sort of inflation. Actually, I don't know if I have the inflation numbers, but the inflation numbers were sort of higher than expected, rather. And so that's interesting, because we know that the Swiss National Bank recently has voiced concern that they were getting into a bit of Switzerland was getting into a bit of a deflationary spiral, and that they might have to cut interest rates into the negative, et cetera, et cetera. So they'll be quite happy that don't seem to have Switzerland here on this list of countries, but basically that was a little higher than expected, and it was unexpected. And so that's a positive, in the sense that for the Swiss National Bank, they may not have to be cutting their interest rates in the negative anytime soon. So just having a look at the reaction to that, if I could find the Swiss franc here. So you see the Swiss franc here didn't really react in a sort of a positive way here. In fact, the US dollar is bouncing a little bit, but that's just something to keep in mind in terms of the future interest rate path for Switzerland. Now, let's have a look at the jobs number. So obviously the importance of the jobs number, I don't have the Bloomberg terminal today. I don't have the connection. So we're just going to look here on trading economics. But what we can see is that at 8:30, we have a huge amount of data. So we obviously have the non-farm payrolls. Now, the headline number here is expected, the consensus is expected at about 110. And just giving the range, I've got the range here just on my phone. So the range here is about, the high is 160 and the low is 70. So 160 to 70, and the standard deviation is about 17.9 thousand. So let's call it about 20,000. So as I say, the median estimate about 110. So obviously that's lower than last time. And the whole question here is that the Fed, as we know, has made it very clear that they do believe that inflation will remain a little sticky and a little sort of more elevated than they're comfortable with for another 2 or 3 months. They're looking for data. They want to know what's happening with the potential inflationary effects of tariffs. I think we all know that. But what Powell has been saying is that were the labor market to sort of weaken significantly or dramatically, that could sort of give them pause, and they might actually get into a cutting cycle earlier than, let's say, September, October, or December, even in July. Now, July at this point, the odds of a July cut are very, very low. And in fact, by the end of the year, we're at about 2.5 cuts by the end of the year. So today's numbers are going to be pretty important. Why are they going to be important? Because either they're going to confirm that the US economy is relatively robust, the employment situation is robust. If we look at average hourly earnings here, let's see, do they go up to 0.3, 0.4, which of course annualized is, between 3 and 4%. Or on the other hand, let's say we get a low number, are we going to get a situation where the economy clearly seems to be weakening, the labor market is weakening, maybe we get deflationary readings from the average hourly earnings. And so this is going to really affect basically sort of the possibility of the Fed possibly, low probability, cutting in July, but especially whether that's going to cement, let's say, September cuts and maybe even push up to 3 cuts priced in for this year. And of course, there's also going to be some political rhetoric. Talking about political rhetoric, we know that yesterday Trump sort of again posted something saying, Powell should resign and all that kind of stuff. So I just wonder, we know the president does get the non-farm payroll numbers, before the public does. So I just wonder if, maybe the number is going to be weak and that Trump has seen the number and he's going to sort of, immediately start shifting Powell, saying that interest rates are too high, et cetera, et cetera. Okay, so just very quickly, if we look at the recent data for employment, I would say on balance, if you look at a lot of things, that essentially it shows a robust employment market, but which is definitely sort of slowly weakening. So not weakening quickly and not a weak market. On the other hand, it's not growing. And there's all kinds of other issues. So for example, as we all know, Trump has radically reduced the number of immigrants coming in. So the pool of labor, of available labor, is much, much less. And so what some people are saying is that the unemployment rate, which is expected to tick up to 4.3, it's actually being held sort of artificially low, if you will, just because the pool of workers is actually not expanding as it had been doing, let's say, over the last 2 or 3 years, because there's just, hundreds of thousands less immigrants. So therefore, the unemployment rate now, there's just literally less available workers. And so even if there are less jobs, the unemployment rate would maybe be sort of more stable than otherwise it would be. So it wouldn't be going up. So that's an interesting little nuance here. So we had ADP the other day, in fact, actually yesterday, that came in very low. So it actually came in as a negative number. A lot of people say that that's not a good precursor to non-farm payrolls. True, but on the other hand, it is a very large payroll company, and another payroll company, Paychex, Paychex, they also are showing sort of, fairly sort of modest sort of labor situation. So ADP and Paychex is sort of a little bit negative. So that's indicating that the labor market is sort of weakening. On the other hand, the JOLTS number, there were more job openings, but there are less hirings and there are less people being fired. So what we're starting to see is that companies don't have the confidence to hire new people. On the other hand, they're still not in a desperate situation that they need to be cutting. So we're kind of in a stasis, in a situation of stability. But there were a few more job openings posted, apparently a little more. And so, we could say that was sort of a neutral number. On the other hand, ISM manufacturing, that number was a bit negative, or when I say lower than expected. So that's not great. And if we've been looking at sort of the 4-week moving average here for continuing claims, that's starting to go up, and initial jobless claims does seem to be going up as well. So I would say at this point, it's a relatively, it's a solid labor market, which is starting to cool. And the Fed is basically saying, hey, that's okay, because with their twin mandates, as long as inflation remains sticky, if the labor market remains solid, they don't need to sort of immediately sort of stimulate the economy. So that's why today's going to be important, because it's going to be an important piece of data. So let's see what we're aiming for. As I say, non-farm payrolls, looking for 110. The whisper number is a little bit lower, around about 100 or so. Employment rate expected to tick up to 4.3. Average hourly earnings, as always, is going to be important because this is going to feed into the Fed's perception of inflation. Now, let's say, for example, that comes in it comes in a little lower, 0.2 or something. Of course, that's going to be, a good thing for the Fed. The other thing, of course, is that we have the initial jobless claims. As I say, the 4-week moving average is ticking up a little bit. Let's see again, what happens there. And the continuing claims is going to be important because one of the narratives around the employment situation is this idea that people are taking longer to find new jobs. So they're taking, 3, 4, 5, 6, 8 weeks to take new jobs. That period is extending. So let's keep an eye on that number together. So we're going to get all of this at 8:30, a big data dump. And then, of course, we're going to get S&P Global Composites final numbers. Probably not so important. Probably what's going to be a lot more important. Keep in mind that American economy, about 70% is service-based. So at 10 o'clock, so an hour and a half after, we're going to get the ISM services. Keep in mind that the employment component of the manufacturing ISM was a little bit weak. So let's see what we get there. Again, consensus is for a slightly expansionary number, just over 50. It's going to be important to look at the employment numbers there, also new orders, and probably prices paid is going to be of great interest to the Fed as well, because, of course, they are very focused here on inflation. So all of these subcomponents to ISM. And then by sort of 10 o'clock, we'll probably have a much better sense of just, of the latest read on the US market. And of course, we have the cash equity market closing early today, sort of lunchtime. The futures open a little bit later, but the cash equity closing. And then, of course, tomorrow is Independence Day in the US, so the markets will be closed, or the cash markets will be closed anyway. Future markets have kind of a half day. So it could be that we have a low liquidity situation, sort of lower in the afternoon as well in terms of the futures and going into lunchtime. So interesting times. One thing I do want to talk about. Let's just talk about potential trades and everything here. So let's just have a look. I think if we come in at sort of over, let's say, 145, 150,000, that would be well above consensus. Keep in mind the standard deviation is about 18,000. Let's call it 20,000. So, anything over, let's say, 145 or 150, that starts to be, a couple of standard deviations higher than expected. And what that would do would probably get the market to have a sort of a rethinking of the US sort of growth trajectory. So not just, sort of a tweak in terms of what the Fed might be thinking, but really to think, hey, US growth is not slowing down. So rather than this sort of stagflationary, it could just be like actually a growing economy with a little bit of persistent inflation, and a very positive thing. That should be pretty positive in the very short term for the equities, probably up 1 and 1.5%. Medium term, though, there could be some concerns with a very, very hot number. Just this idea that maybe the Fed might actually sort of start to dial back expectations for cuts. So funnily enough, I think if we do get a very strong number, let's say 150, 160, in the very short term, like today, maybe the next 1 or 2 trading sessions could be positive. But medium term, I think the market will be less happy with that, because it could start to call into question the whole idea of whether the Fed needs to be cutting quite as much. So that's interesting. I think really where the market would be quite happy would be something like, let's say, 120 to 140, 125, 145, in that kind of range there. So a little higher than expectations. That would be bullish. It would be lower than expected in terms of the impact from the trade war. It almost could be like a Goldilocks scenario. So I think in that scenario there, it would indicate that the labor market is still strong, but not too strong that it would derail the Fed from cutting at some point in 2025. So I think the market would like that. I think equities would go up there, front end would come off. But that would be a sweet spot. And I think over the medium term, that would possibly be the best scenario for the equities. Again, what the market is probably expecting is, let's say something between, let's say, 105 and 125. So that's more or less in line with consensus. That would still be a very good number. That's still absolutely okay for equities. The stocks would continue to remain bid. The status quo essentially would be unchanged in terms of, what the Fed is thinking there. So again, medium term, I think that would be quite a strong number. Maybe not such a bounce in equities, but still a pretty strong performance. So what happens if we get a lower than expected number? Let's say something like 85 to, I don't know, 105 or something like that. We're starting then to get the risks of like a stagflation. So we have an inflation remaining sticky, but it looks as though the real economy or the labor market's starting to weaken. That's a tricky one. I think ultimately, the equity market might come off a little bit here, probably, not bad for the front end of the curve. And then probably in terms of the medium term sort of outcomes, the market would have to then really start thinking about potential tariff deals. We had a Vietnam deal yesterday, and the market could live with something like that. So that would be that one. And then finally, what about a really weak number? Let's say less than 85,000 or so. At a minimum, the market might start thinking, not even about stagflation, but maybe more sort of a recessionary kind of vibe, negative growth, but with still, sort of inflationary worries. That would probably be a pretty bad outcome for the market. And to be honest, I have to say, I think see the SPX at that point, probably having a 1.5 to 2% sort of fall off if we get that lower number. And again, I think it's going to be fairly easy in terms of the stocks. In terms of the bonds, anything sort of higher than, anything which calls into question that the Fed sort of cutting at least twice this year, the front end of the curve will not like it and will get a bear flattening kind of situation there. So what would that magic number be there? I think anything above, let's say 115, 120, anything above there, the front end of the curve will definitely not like it. Status quo, is going to be 2 to 2.5 cuts, anything around about, let's say, 95 to 110,000 jobs. I think the front end of the curve will be sort of okay with that. And of course, anything below that, anything, let's say, sub 100, sub 95, at that point, we start to sort of maybe price in 3 cuts this year, and maybe even a little bit earlier. And of course, that would be positive for the front end of the curve. So we could get a front end led bull steepener at that moment. But again, I urge everyone, we have to look at the average hourly earnings, because if the average hourly earnings remain hot, that's going to sort of give the Fed pause in terms of inflationary concerns. So if the average hourly earnings are cool, but the headline number is solid, I think the front end of the curve would like that as well. So that's very important to kind of factor in terms of inflationary thinking, the average hourly earnings. And of course, a bit later on, just in terms of as we progress through the day, to look at the prices paid for the ISM services. Now, of course, that's at 10 o'clock, so an hour and a half later, but that's also going to be important. And of course, let's not forget about the initial jobless claims as well. Just finally, guys, there has been some talk. Besant was saying the other day, he said the quote was, why would we issue long-term bonds at the current yields? And there was sort of some, and we had Trump the other day saying that he didn't want any bonds issued, longer than 9 months duration, et cetera, et cetera. So there are some people saying that at 11 o'clock today, this is another thing to keep an eye out. At 11 o'clock today, the Treasury, and this is normally a non-event, but the Treasury is going to be announcing its sizes of auctions for next week for the 3-year, the 10-year, and the 30-year. Now, I don't expect there to be any changes because that would be quite radical. But, if the numbers announced, especially for the 10-year and the 30-year, are lower than what is expected, this could signal that in fact the political pressure is getting to the US Treasury, and they are going to start cutting back the amount of issuance for the long end of the curve. Now, this is going to be great for the long end of the curve in the short term, and that would be, in theory, this should be very, very good for sort of risk assets like stocks. Should absolutely love that because, less a long-term bond issuance, and that should really cause the curve to sort of bull flatten at that point as long-term yields would come down. So what is expected? You might want to write this down if you're interested. The 3-year, we're expecting $58 billion. The 10-year, $39 billion. And the 30-year, $22 billion. So the 3-year, 58, the 10-year bonds, 39, and the 30-year, $22 billion. If those, especially the 10 and the 30-year, are lower than those numbers, that's going to get a significant, I think it's low probability, but that would get a significant market reaction. And we'll get the long end of the curve loving it. And also risk assets like stocks would love it because it would almost be like some kind of sort of almost like a QE situation where there are less bonds being issued and the yields would be going down. So that would be very, very positive. One thing I just want to leave you with this idea of the US dollar. We all know the US dollar has fallen a lot over the last few months. Every man and his dog is short the US dollar. The positioning is getting quite stretched in an extreme way short. So let's say today we do get hot data, 180,000 jobs, maybe, average hourly earnings strong, initial jobless claims, continuing claims lower than expected, and a strongish ISM services. If we get all of that package of hot or strong data, it wouldn't surprise me if the US dollar has a pretty significant bounce and we have some kind of short squeeze. Because as I say, everyone is short, positioning is very, very stretched, and the pain trade at this point would actually be a rising US dollar. That would cause quite a lot of pain. So that's going to be an interesting one if we get a hot number as well. To think about that. Okay, guys, I'll leave it there. Let's all get organized. Sorry, as I said, I didn't have the Bloomberg with all the numbers. The connection is down. But have a great day and enjoy yourself. Thank you.